Hi everyone, so this will probably be a little bit of a longer video. I hope it'll be useful, and it's just kind of about although the interest rate has dropped in the UK in November 2024, it has dropped from 5% to 4.75%, but realistically that's not going to be the I suppose the biggest thing that's going to happen. So what do I mean by this? It's just that, realistically, unless you're holding a really massive amount of cash just in, I suppose, just regular savings accounts, it's not going to be a huge impact if you earn a couple of pounds less a year or what have you. There is a slight anomaly that Trading 2 and 2 is actually got its rate is 5.175% AER, which is a bit unusual to be above the base rate. Also, they might correct this quite soon, but that's kind of a very good one because it's a daily interest. It is a qualifying money market fund, so it's not necessarily has the same protection as a bank account, so that's just something to keep in mind. So this isn't financial advice, but it's just some ideas for how you can make more from the money that you've got in savings or what have you, or save money, so you can save money from I suppose your normal costs, so that you can either invest with it or do as you like with it. So if you're liking the content, please follow and subscribe, and that'd be great. And you can also turn on notifications so you won't miss any new videos. But basically, I did a short video on this, but just to expand upon that. The average person under 34, I believe it is, has only got a few thousand in the bank. So even at 5% interest, you're only talking 180 or so pound a year that you're going to get in the entire year, and that's if you don't touch it and have basically all your savings just in a fairly high rate, around 5% savings account, you're only going to get £108 in a year. And although, yes, if you do keep it in there, it'll potentially keep going up. But in reality, it's not actually making money because inflation is at a similar rate to the base rate. So, even if, yes, you're getting 5%, probably by the end of the year, prices may have gone up by 5% or more on the average spend in your household, probably more. So realistically, although you're getting £180, you're not really keeping it. It's just going to go in your other costs. Whereas what you can do, so also if you just have a single current account, when you switch them, you can always just kind of hold off until you see a good offer. So there's often ones that are £200, £180, like Lloyds, NatWest, all those kind of ones have had those type of switching offers recently. So they don't tell you when they're going to end. So if you do see a good offer of, for example, £200 for a switch, it's best to do it straight away, switch the account, 10 minutes, 50 minutes, an hour, but whatever it is, that's pretty good return. And what you can do, and I think I did mention in the other video, it's not financial advice, and you do have to be careful doing this, not to open them too close together, like maybe one per year or something. You can have multiple current accounts, and then obviously when you switch any of the current accounts, you will get can get the bonus as long as you meet the criteria. There's normally like minimum money you've got to put in, which you can then take back out. There's often, a minimum of like 2 or more direct debits you've got to have, what have you, which you'd also need to have funds in there to cover, otherwise they'll, bounce. But, there's various rules that I won't go into too much, but, you've got to look at the criteria there. But imagine if you've got 5 current accounts and you swap them on average once per year, you could be earning £200 a year from this. So you potentially could be earning more money from account switching than you'd earn with the average level of money, in a interest account, in a year. So if you get £200 a year, and also you get it all in one go, and then obviously with that 200, obviously you can just put it in a high interest account, and get 5% on it from day one. Whereas, if you're getting interest over a year, you might only get 1/12 of that, so you're going to make more interest from having £200 from day one and get interest on it for a full year, rather than, if you have £25, or actually it'd be less, wouldn't it? It'd be, £18 or so per month, interest. And that's if you have all of your savings in one place, and you get 5%, which obviously, like I say, is becoming less likely now. So that's just something to keep in mind, that you can make quite good money that way. And then you can you could either do that and just, I suppose it's a safe but low return. If you're just having a high interest normal savings account, or you could if you don't I suppose if you don't particularly need the money, because obviously there's always risk with investing, because it can go up, they can go down. You could have it in investments, and even fairly modest investments. For example, this year, if they've been in something like S&P 500 or something like that, might have gone up 20-30%, right? So you could potentially be turning that £200 into, it depends what you think it'll go up in a year. Say if it modestly went up 10%, which is pretty typical, I think, for S&P 500 over the last 90, 100 years. You'd have 220, and then that could potentially keep happening for several years, and you could keep putting, even if this was the only money that you put into that type of account. So they could be general investment, but for most people, you might want to put it in a stocks and shares ISA, because it's tax free and any income is tax free on it there. There's normal limits on those, 20,000 per year, you can put a maximum in there. Or if you're saving for a house, again, even if this is the only money you have to save for a house, if you put that in a lifetime ISA, which can also be a stocks and shares lifetime ISA, but if it's a cash lifetime ISA, for example, you'll get the 25% bonus on the, for example, £200, so it's £50, free. And then you'll also get normal interest on the full balance every, whatever the terms is of the provider, maybe once per year, maybe once per quarter, etc. So if you've got that in there, if you're getting another 5% then on the 250, that's just a few more pounds in there, helps just a little bit more. But if you imagine, if you're doing this every year and you're building it up, after a few years you might have a £1,000 in there, and you might have got £250 back plus all the interest, which might also be £250 or what have you, depending on the interest rates.